Assalamualaikum. Our group will be presenting the importance of information disclosure in financial reporting. So, what information disclosure is? Information disclosure refers to the provision of relevant material and reliable information in financial reports, including notes and additional explanation beyond the main financial statements. Next, why disclosure is important? Disclosure is important because it enhances transparency and reduce information asymmetry between management and users of financial statements. Investors and creditors rely on disclosure to make informed economic decisions. So, without adequate disclosure, financial statements may be misleading or incomplete. Therefore, the objective of this assessment is to analyze the importance of information disclosure in financial reporting by reviewing two academic articles and evaluating how disclosure improves the usefulness of financial information. For this assignment, our group selected two academic articles related to information disclosure. The first article focused on operating segments disclosure. The title of the article is Segment Disclosure Practices and Determinants, Evidence from Romanian Listed Companies, written by Rosandra Adriana Matescu and published in the International Journal of Management Science and Information Technology in 2016. The second article focused on related party transaction disclosure. The article is titled, Does Related Party Transaction Disclosure Affect the Value Relevance of Financial Statements? Written by Prihastiwi Nugraheni and Pramudia Stuti and published in Journal Akuntansi Contemporary in 2023. This article was chosen because they are relevant to our course and directly related to the topic of information disclosure in financial reporting. Both articles are published in reputable academic journals and provide clear explanation and real example of disclosure practices. In addition, the article helps us understand how operating segments and related party transaction disclosures improve transparency and assist users in making better financial decisions.
Now, I'll start with this article titled Segment Disclosure Practices and Determinants, Evidence from Romanian Listed Companies. This study investigates how companies listed on the Romanian stock market comply with the requirements of IFRS 8 operating segments. And it also explores what factors influence the quality of their segments disclosures. In the first part of the article, the author examines how Romanian listed firms report their operating segments in practice. Operating segments are part of a company that engage in business activities and whose financial results are regularly reviewed by management. The study looks at what kind of information companies typically include in their segment reporting, such as revenue, profit or loss, and assets, and whether this information meets the expectations under IFRS 8. In the second part, the article investigates the determinants of disclosure quality, meaning it tries to understand why some companies provide better segment information than others. A particular focus is on the role of corporate governance, such as the independence of the board of directors, and whether this affects how fully companies disclose segment information. The author also considers the internal factors that might influence how the IFRS 8 standard is implemented. Overall, the article combines both theory and empirical evidence to show how segment reporting practices are applied in a real market and which factors help determine the quality of disclosures, providing useful insights into how IFRS 8 is interpreted and applied by companies.
Next, I will explain why the disclosure of operating segments is important. First, operating segment disclosure helps in risk identification. Different segments operate in different economic environments and face different levels of risk. By disclosing segment information, users can identify which segments are more exposed to risk and assess the overall risk profile of the company more accurately. Second, operating segment disclosure plays an important role in enhancing transparency. It reduces information asymmetry between management and external users by providing detailed information beyond consolidated financial figures. This allows users to better understand how each segment contributes to the company's overall performance. Third, segment disclosure enables better performance evaluation. Investors and analysts can compare the performance of individual segments, identify profitable and underperforming segments, and evaluate how efficiently management allocates resources across the business. Fourth, operating segment disclosure leads to improved investment decisions. Segment-level information improves the accuracy of cash flow forecasts and help investors assess the growth potential and sustainability of each operating segment. Fifth, comprehensive segment disclosure reflects strong corporate governance and accountability. It demonstrates management's accountability in reporting internal performance and increase users' confidence in the reliability of financial information. Finally, operating segment disclosure supports compliance and comparability. Compliance with IFRS 8 ensures consistency in reporting and allows users to compare companies operating in similar industries or markets more effectively.
Bismillah, so for this part, I'll be presenting the summary of Article 2, which discusses related party transaction disclosure. This article examines whether the disclosure of related party transactions improve the value relevance of financial statements and how investors respond to separate and detailed disclosure of this transaction. The study focuses on non-financial companies listed on the Indonesian Stock Exchange over a 5-year period from 2016 to 2020. The researchers use regression analysis as the main research method, and abnormal returns are applied as a measure to capture investor response to related party transaction disclosure. The findings indicate that separate and clearer disclosure of related party transactions provides additional useful information to investors. Companies that disclose related party transactions more transparently tend to show higher value relevance in their financial statements. Overall, investors are found to respond positively to detailed and transparent RPT disclosure. The article also explained that related party transactions may be conducted for legitimate business purposes, but they also involve opportunistic behavior by controlling shareholders. Therefore, disclosure allows investors to better assess the nature of this transaction and distinguish between normal business activities and potential opportunistic actions.
Next, I will explain the importance of related party transaction disclosure. And they have several reasons. First, it helps prevent abuse and conflicts of interest. Related party transactions may be used to transfer profits, hide losses, or benefit controlling shareholders at the expense of minority shareholders. By requiring proper disclosure, shareholders are able to identify these transactions and assess whether they may involve conflicts of interest, and this can improve transparency and reduce the risk of opportunistic behavior by management or controlling shareholders. Second, related party transaction disclosure can improve investor decision making. When these transactions are clearly disclosed, investors can assess whether the transactions are conducted at arm's length. They are also better able to evaluate the sustainability of the company earnings and make more accurate estimates of the firm value. As a result, investors can make more informed investment decisions. Last but not least, related party transaction disclosure can ensure compliance with accounting standards. Under IAS 24 and MFRS 124, companies are required to disclose the nature, amount, and also relationship of related party transaction. These standards aim to promote transparency and protect users of financial statements by ensuring that all material related party transactions are clearly reported. In conclusion, related party transaction disclosure is essential in enhancing transparency, strengthening corporate governance, and also maintaining investor confidence.
Hi, Assalamualaikum. My name is Nurden Amity Zakaria with metric number 1233014. Next, I will continue with the reflection of this group project. In our group discussion, we learned that transparency is very important in financial reporting. Consolidated data can sometimes hide real performance. From Article 1, we understood that operating segment disclosure help management and investors see which region or segments are truly profitable. In Article 2, show that disclosure is not only a legal duty but also a positive signal to the market. Companies that share more information gain higher trust. Detailed disclosure gives more value than numbers alone. Our group agrees with the authors that internal factors such as company size and the presence of institutional investors are the main driver of high-quality financial reporting. We also strongly agree that related party transaction (RPT) must be disclosed in detail. Separating RPT, sales from third-party sales, is very important because without this, minority shareholders cannot detect possible profit shifting. Overall, we believe operating segments show where a company performs well, while RPT disclosure explain how the company operates fairly and ethically. From this topic, we learned that operating segment and related party transaction disclosure help reduce information gaps between manager and investor. Disclosure allows investor to see information that is usually only known by management. We also learned that disclosure helps protect minority shareholders from unfair internal transactions by majority owners. Lastly, standards such as IFRS 8 and IAS 24 are important because they make financial reports comparable across countries, allowing investors to assess companies' use. In conclusion, our analysis shows that ownership structure and the type of relationship within a company strongly influence how complex financial reporting needs to be. We also learned that transparent disclosure improves market confidence and is closely linked to better market performance. Finally, accurate financial reporting is not the responsibility of one party alone. It requires strong cooperation between the board of directors, auditors, and management. High quality disclosure is a key sign of a trustworthy and sustainable business.